have the great pleasure to be hosting this very first panel here, and I'm extremely excited to have three distinguished speakers with me. The first one, I would like to introduce Alison Martin. Alison Martin is the CEO of EMEA and I think the bank distribution channel at Zurich Insurance, and I've known Alison for a long time. She was with Swiss Re years and years ago. This is where we met. And Alison has been very vocal about cyber risk and insurance for years now, so I'm very happy to welcome Alison.
Thank you.
Then we have Peter Deans. He is the CEO of Not Without Risk. Peter is a former chief risk officer, so he knows actually what we're talking about. When we had our preparation call, he also told me that he was responsible for looking into buying insurance for his then employer, the Bank of Queensland. And so I'm looking forward to getting your views on that interesting topic.
Thanks.
Welcome. And last but not least, Jack. Jack is the director of and head of risk sciences at Riskland, so also a distinguished risk and experienced risk expert, and he will bring his views into the topic from yet another angle. Welcome, Jack. So before we start with the discussion, I would like to scope a little bit the discussion that we are going to have here this morning. The reason for that is cyber risk, and even if we're talking about quantification of cyber risk, is a very, very wide field, right? We could talk about cyber risk for countries, for nation states, we could talk about cyber risk for individuals, we could talk about cyber risk, actually one of my pet topic at the moment, for cities and other kind of organizations that are not companies. But here and now, to make it a little bit more tangible, we would like to concentrate on cyber risks for companies, and that can be large companies, it can be small companies, and I know there's a huge difference usually in the management and the understanding of cyber risk in those different types of companies. We are not going to cut in any industry segments or so, but that should be the scope of the discussion here, is cyber risk for large and small companies. And we would like to discuss basically two questions. I hope that you get out of this panel and know a little bit more about these two questions. So the first one is, how can cyber risks for a company be quantified? So we'll discuss this extremely important question in this panel. And then the second question is a little bit provocative. Me coming from insurance, being an insurance professional myself, like to kind of provocate on that a little bit. And the question is insurance useful with respect to cyber risk mitigation and management? So I will hopefully let my distinguished panelists do most of the talking. It could be, and I excuse myself already up front, it could be that I can't hold back and will also, add a little bit. So I'm the head of cyber and digital risk at Swiss Re. It's a large reinsurance company, so I'm also from the insurance area. So if there is something that we kind of I can't keep in, I'll also contribute to that. Hope that is fine. Good. We will discuss these two questions in as much depth as we can get to in this short time that we have. I would like to give you at the end like 5 to 6 minutes to ask questions, because I know that Alison at least will have to leave pretty soon after the session, so that and then you would not get any chance to talk to her, but maybe also to the other panelists. So there will be a short question and answers time allocated at the end. Great. So, big first question is, how can cyber risks for companies be quantified and managed? And actually, I would like to start a little bit broader than that. Maybe Jack, from your experience as a risk professional, are all companies nowadays actually exposed to cyber risks?
I think there are
probably a few that maybe not so much, but
give me an example for that.
I'm trying to think of all cash businesses that don't operate on the net. Like, I'm sure there's a few of those still out there, but I think in large part, I think you're right. I think many of them are. All of them that have risk exposure that has to do with operationalizing their businesses using computing technology have that sort of problem. Myself and my co-author, we've been quantifying cyber risk for firms just such as this for going on 15 years now. The standard for that is the FAIR standard that we wrote our book on. And so what we come across a lot is organizations that believe it's a very intractable problem. There's no way we could possibly put numbers around how much loss exposure we could have. I'm beginning to think that there might be more in it for security professionals, more in the problem than the solution for a lot of security professionals, because there are a lot of practices, a lot of techniques for doing just such quantification. And as a risk professional, and as an insurance professional, you're aware of many of these kind of things, that you can write insurance policies on virtually anything. That there are a lot that believe that this is not a thing that can be done. And something we spent a lot of time helping executive boards through is saying, we can put numbers around this for you.
Okay, Jack, what I take back from your answer is there are probably companies still nowadays that are not exposed to cyber risk. So I'll take that with me and I'll, check that with as many as...
I'm a statistical thinker, so there's probably some non-zero number of companies that are exposed.
So if we have cyber risk, if they manifest, they lead to losses, right? They lead to something that's bad for the company. Alison, in your experience or knowing that you are well versed in cyber risk insurance, how do they manifest? What happens when a cyber risk actually manifests? What can happen?
So I guess it depends very much who has been targeted and whether it's critical infrastructure, so whether it's taking out electricity grids, which obviously we've seen, whether it's breaches, which are actually designed for malware and ransomware, and it's more about trying to just acquire monetary, it's classic fraud, criminal activity, or whether actually it's for data loss, and actually it's to sell data onto a variety of, again, criminal enterprise. So it can manifest in many, many different ways. But just picking up on your first question about who is exposed, I think it's really important that everyone remembers that 3 out of 5 large companies have been successfully attacked, and nearly half of small companies have been successfully attacked at least once in the previous year. When we look at the regional risks of doing business, which is the World Economic Forum's report for business leaders, what do they most worry about? I could argue they should worry about climate change, but we're at the cyber future conversation, so I'll talk about cyber, which is luckily very consistent with actually what business leaders find most concerning. So actually in Europe, cyber attack is the #1 risk of doing business. In many other countries, it's the same. It makes it into the top 3 worldwide. And I think that's just a recognition of the fact of how much concern businesses face. I mean, the average attack costs about 8 million for a large corporate. That's not an insignificant, and if you think that 3 out of 5 have been successfully attacked, that's a large amount of money, a lot of which is going to criminal enterprise.
Well, you say 3 out of 5 have been attacked. I think if you look at the data sets around incidents, it's a very power law kind of distribution. By and far, most of those attacks are virtually $0 losses. There are a handful that we think about, our minds go immediately to that really, exactly, yeah. So finding that needle in the haystack and not overselling the FUD when you talk to the boards and you talk to executive leadership around, here's why cyber is important, is really critical to that, I think.
I think that might actually be a good point where we have to distinguish between large and small companies, right? Peter, can you add to that?
Yeah, we've covered a lot of territory in 5 minutes. I think just maybe start with the side of reporting first of all. I think that's a very granular question for, I think, cyber risk professionals or cyber security professionals. I think as you go up the organisation, larger organisations, it becomes more around what's the cyber security or cyber risk profile of the organisation, trying to explain it in plain English, non-technical terms, particularly if you're talking to stakeholders, be it the C-suite executives, board, or even if you get outside in some sectors such as the financial services sector, where you're talking to regulators. Yes, the reporting is important, but at the end of the day, it's understanding the cyber risk profile, understanding what the organisation is doing to understand the risk profile, take whatever necessary action. I think that's really number one issue, I think, for larger institutions. I think a close second, and just leveraging off Jack's point around quantifying losses, a close second is really business continuity, because the investment which is made is not so much to avoid losses, it's actually to keep the business going. And maybe we'll talk about Travelex during today. It's still not clear exactly what's happened or how, but quantifying losses for a business like that, where the business has ceased to operate substantially for a period of time, it gets onto the old areas of reputation risk, confidence of business partners, confidence of customers. If you're publicly listed, loss of market capitalisation. I think it's almost a bit of a futile exercise quantifying that, because it comes to the core survival of a business. And I think small, medium and large businesses have to stare into this, that it really is more of a higher order issue around business continuity and cyber resilience. Some of the micro detail of how you're organised, the reporting, insurance and mitigation, that sort of flows a little bit after that. And again, I think for larger institutions, all the stakeholders, board of directors, they just want the organisation to get it right. That's a very non-technical term, but I think everyone's dealt with CEOs, and they just want to say, can you fix it? Well, it's a bit hard to fix it, but I think it comes to cyber risk profile and longer term resilience and business continuity.
So I understood from you that yes, reporting is important, and talking about it in any organization is important. I think that is one of the things that maybe we can go into in just a minute in terms of how do the cyber security professionals talk to their board also about it, or to their executive management. But what you said just now, Peter, I got is it's. We have to take the first step in trying to understand really what is the cyber risk profile, and how do you do that? How do you do that, Jack?
I think far too many companies, when they think about building a cyber risk profile, default to some notion of what kind of security controls do we have, or how mature am I compared to my peers. And the trouble with these kind of notions of risk profile is they ignore the thing they're actually trying to do, which is how much risk am I exposed to. So these kind of approaches, and many standards support them, suffer from this thinking that there's a linear relationship between the amount of things that I buy and how much less risk I'm going to have. As if you buy more security controls, you're going to be less risky. We all wish that was true, but that's not the case. And in any organization, rationalizing capital expenditures is really important. How much money you spend on anything, whether it's security or buying a new business or investing in a new market, all comes down to risk and reward and what's the trade-off there. So for organizations that are trying to really present board-level profiles for risk, my personal approach is I like to roll those up to some kind of categorical types of risk. A lot of organizations do this and tie that to risk-based capital profiles. So even for organizations that don't have RBC kind of requirements, and you can still use, I like the Basel II categories. Here's what fraud looks like to us. Here's what this looks like to us. If we have fraud exposure, it could look anywhere between this amount and this amount. And to touch on your earlier point, when you start thinking about how much losses are going to be to completely eradicate this business, I don't know that it's futile. I think there's a limit of usefulness to how bad those things go. Having those kind of levels of things are important as well. Capacity, appetite, limit. Those are valuable levels.
Yeah, I guess my point was probably more. I'll try not to use the banking analogy, but if you look at an airline, for example, the starting point, and I think a lot of people are familiar with the ISO 31000, which is the risk management industry standard. I have some problems with it, but that's a separate discussion. But the first step is explain the context. And I think when you get to board, stakeholder, and even C-suite, it's like you need to start to explain the context. And if you think of an airline, they'll have the planes, they'll have the ticketing systems, they'll have whatever's behind the hangars with engineering and training and so on. It's really looking at that to start with before you get into, I think, this detailed quantification, because each of those business activities will have a very different risk profile. That's before you get into third parties such as air traffic control, the supply chain and so on. And again, for banks, for us, it was keeping the doors open, keeping the ATM networks, being able to process transactions, and that was very much explained in the context, and we worked backwards from what can disrupt that, both in a cyber perspective and also a non-cyber perspective as well. And I think that's very much the conversation that, for corporations to succeed in this space, they need to start with, and it's really business engagement as well, which I know is a topic for sometimes during the day as well.
So you work with scenarios then to go through them? Okay.
Yeah, and it's also, sorry, just going to take one more point. It's actually going to the business area saying, head office, we can sort of help you a little bit, but you need to understand and articulate what your business operations do and what the risks are.
I think that scenario piece is absolutely critical, and that notion of controls-based security and risk reporting presumes that lists of broken things are our risk and not the scenarios that can cause downfall in organizations.
Excellent. Alison, knowing that insurance needs to quantify risk in order to underwrite them, what would be your answer to that quantification question? How does insurance deal with that?
So I think that from a measurement perspective, I probably would bring this back to the most basic level, which is in order to understand potential impact, you need to know what your vulnerabilities are and you need to understand what the threats are. Because a vulnerability may be completely okay and you may be happy to accept that you have that vulnerability if you don't think you have a threat which could actually target against it. So equally well, you may find that you don't have very many vulnerabilities, but you're a very, very high-risk target, and in which case you need to prioritize your efforts and resource. So on the quantification side, there are so many factors that could actually go into this. I would very much agree with what Peter was saying, right? It's actually about scenarios. The way that we look at this for ourselves, because obviously as an insurance company, we are a potential target of cyber attack, but we also obviously take other people's cyber risk. It's very much to look at what's an integrated approach to looking at what your security baseline is. So where are those vulnerabilities? Where would you see that you have an appetite for accepting a patching, for instance, or risk awareness of your employee population? What's your threshold for which you are willing to accept that risk? And then what are the threat scenarios? And if you apply the threat scenarios against your landscape of vulnerabilities, what kind of outcomes would you get? I think you have to, it's very easy as an insurance professional to say there is a right answer, that the model will give us the right answer.
It will give you an answer, right?
Exactly. Can I just put aside that fallacy? Yes, the model will never give you the right answer. It will give you, ideally, a very good model will give you a range of plausible outcomes which you can influence where you might be in that range of plausible outcomes because of the actions that you take. But there will never be one answer. And if anyone tries to tell you that, then it's a bit of a fallacy.
And it's actually a little bit of a statistical approach as well.
Absolutely. All models are broken, some are useful, as they like to say.
Exactly.
Okay, having now talked a little bit about where we are in terms of understanding cyber risks in an organization and also how to quantify it. If I look around, I see a lot of question marks in people's eyes when this topic comes up. I don't think that this question has been answered on a global scale. I don't think it has been answered for a certain industry in a certain jurisdiction. But my question is, what needs to be done? What do we need to know more in order to get a better grip on quantifying cyber risks in organizations, in companies, small and large, and who could help us with that? And I would like to get all of your answers on that last question on this first part.
Well, I'll start. I think if you look to organizations like the FAIR Institute that is working to make organizations aware of the ability for cyber risk quantification to help them clarify and understand their risk profiles from scoping to calculation to reporting.
So basically one by one, you catch them one after the other, is that?
The FAIR Institute is quite large. There's 6,000 members across the world, lots of local groups. So that is one way I think that we go about this. The Fair Institute is also, my work there is that we've mapped quantification standards to existing cyber risk frameworks like NIST and COSO, PCI. So we're trying a lot of outreach in that way to do similar kinds of things.
Okay, thank you. Alison?
If I go for the typical boring insurance answer of data, sorry. What's the most important thing that you need, accepting what I previously said about models and the fallacy of models giving you the right answer, actually models get better the more data you have. So I think the sharing of data, whether it be of successful attacks, but also importantly the unsuccessful ones, and most importantly, what was the mitigating action that resulted in that being an unsuccessful attack, so that we can more quickly spread that kind of knowledge. So for me, it's the data sharing in a way which cuts across industry and competitive challenges, so that we can actually use it.
I'm putting you on the spot now, Alison. I'm sorry for that.
I opened it for you.
Geneva Association has a data sharing kind of concept where insurance companies are, asked to share data on cyber losses, cyber incidents with each other to get more data to become a lot better very, very fast. Is that something that you think everybody in the insurance industry should support?
If everybody supports it, then I think it can absolutely work. I think the challenge is going to be is if some players who have a lot of data don't use it, then I think we will find it's not as useful as it could be.
I actually found out in my work at Swissly that there is a trove of unused data in each organization that one can also make use of, just to add to your point here.
I think for me, I think benchmarking internally and externally is a key thing. And again, for institutions starting on the journey, it's like, well, let's have a look at what we're collecting, what we use today for whether it's reporting or incident response. But I think you do need to reach out externally to peers. Benchmarking was probably one of the key bits of advice I'd give institutions.
Okay, great. Thanks a lot. I took from that last what we need to be doing now, right, to get better at quantifying cyber risk is basically making use of organizations that go out there and do that professionally and make use of that. And it's every single organization can actually become better in understanding their own cyber risks with a little help. We need data to be able to get better models and also on a broad scale to be able to quantify cyber risks better. And then internally, each and every company is responsible for its own. That's what I heard from you, Peter. Also benchmarking here, talking to peers. That's again is data, not data exchange, is more experience exchange maybe. And insurance could actually be a little bit of a moderator in that context. Excellent. So you see me and hear me kind of running a little bit because we need to go over to our second question. It's my favorite question, obviously, coming from insurance. The question is really, and a lot of people ask me that when they notice that I'm an insurance professional, what's the role of insurance and does it actually make sense, cyber insurance? What does it mean? So let's try to kind of answer a little bit around that question and maybe get to some answers also what needs to be done then at the end. So maybe before we really tackle insurance as such, insurance being one of the risk management practices that are normally employed in the normal risk management process. Maybe, Jack, can I start with you again on what is usually done in terms of risk management when we come to cyber risk? What are normal practices? We heard a little bit about that before. You also mentioned some of the frameworks that are out there. So can you just kind of line out a little bit of your understanding, and then maybe we can link insurance in and see where that fits actually, or not.
Yeah, so when I think about organizations that are purchasing cyber insurance, and I've been internal to some banks that have done this kind of exercise, it's important to think about insurance as just a control. It's a type of tool that you can employ to transfer risk in this case. So the really important question is if I'm going to spend, I don't know, $1 million in premium on a cyber insurance policy, is that the best investment for those dollars? And I don't know if it is, but it's important to have a sort of internal analysis to say, gee, if I put that $1 million internally and I bought XYZ controls, would I reduce my overall risk profile to an acceptable level? Or if I purchase this policy, I still have that loss exposure, right? But now it's mitigated by this other solution. So those types of risk-reward trade-off conversations, I think are sort of a prerequisite to insurance purchase decision and thinking about how much we have. I've been internal with some organizations that have literally said, we could afford a policy, but we're going to self-insure instead because we have considerable capital reserves to do that kind of thing. And the other pressure I think you're seeing, it's interesting, is a lot of third-party contracts now are requiring that kind of thing too, which I think will definitely put a lot of pressure on the cyber insurance market to write policies to enable businesses to operate.
If there is property damage as a result of a cyber attack, so your laptops, for instance, need to be replaced, does that count as normal property damage? Now, most cyber policies on a standalone basis would absolutely cover that. Most property damage covers would not cover that because cyber was not contemplated at the time the coverages were written. But this is obviously the cause of, I think it's fair to say, a few arguments in the courts to determine exactly which way this will end up. I think, so you can, our strong advice would always be, if you want to cover yourself for cyber risk, buy something that is for covering cyber risk. Don't assume that you might be covered under a different policy that has a different heading and was designed for something else. It's always
a good insurance lawyer.
That's also probably a good idea. But fundamentally, if you want to be covered for cyber, then buy a cyber policy. It's a bit of a no-brainer. Now, you can either cover your own damage, so a first-party coverage, or you can cover the liability you may have under third-party coverages. Now, in some jurisdictions, you can actually insure fines. In many jurisdictions, you can't, because obviously there has to be insurable interest, and we also need to avoid moral hazard. And I think that's always obviously a key risk for insurance companies, and actually for the C-suites of organizations, you shouldn't assume that just because you have an insurance policy, that any GDPR fines you may have for a data breach, that suddenly the insurance company is going to magically pick that up. Typically the answer is no, they will not pick that up. But they will absolutely cover liability, they'll cover restitution costs, they'll help you get back on track, and the speed with which you can do that, I think, is often one of the critical things in having a cyber policy versus not. It's getting access to being able to get people on site very quickly, to clean, to get your data back, to get things up and running. I mean, we've talked a tiny bit about supply chain. Yeah, we talked a tiny bit about supply chain, you mentioned it, but I think you also have to bear in mind that is it actually your business continuity, or are you reliant on your supply chain having business continuity, and what alternatives do you have? So you can, when you're thinking about what coverages you need, to Jack's point, what are you asking your suppliers as to what actually they have? How quickly can they get back on track, or what alternatives do you have?
I completely agree with what Alison said around getting yourself back up and running quickly. I think there is real value from having third-party support through the insurance policy there. The one, again, I probably labour this point, particularly for publicly listed companies, there is clear value. If you have an event, and let's say you quantify the loss in the first few days or the week of, we may have to spend $50 or $60 million remediating or doing something. To make that statement, it's fairly painful, particularly if you move into the privacy space as well, where that has a whole lot of other challenges with it. But to be able to say we have a cyber insurance policy which we believe may cover up to 20 of the 60, that carries, I think, disproportionate value and weight in terms of lessening the reputation impact, lessening the market share impact. If you just went out and had to answer the question, which you'll inevitably get from analysts or investors on, do you have insurance coverage? To say no, unfortunately it's going to have a detrimental impact, even if you've gone through the analytics a year or two below to say self-insurance is the way to go. But something goes wrong, the story gets painted in a slightly different way to if you had insurance cover, even if it's for a small amount. And again, this is a bit of the nuance you'll get from boards and the C-suite, because they'll be thinking of these types of scenario outcomes, even though technically or economically it may not be the right answer at the time.
Okay, thanks for that. I still, again, have to run, so I'll have to start closing this second question already. And again, I would like to close with in that space, we've now heard what can be insured. We've heard what's the value actually, or also, where do companies not buying cyber insurance specifically, what does it mean? I would like to hear from all of you very quickly what you think needs to be done to either get the insurance industry to offer the right products if they are not the right ones, or make sure that all the companies that are currently not buying cyber insurance, because the market, Alison, would be way bigger if everybody was looking into that, especially also the smaller companies. What is needed? What's the next steps here?
It's a slightly self-serving question, I suppose.
I'm totally interested in your answer.
I'm teasing you. I think more literacy among corporate governance around what loss exposure looks like and what are the options available to manage that. I think that really helps organizations better. Whether the ultimate answer is to lead them down the path of buying insurance or not, I think just understanding what that looks like, I think, is very helpful.
Okay, thank you. Alison?
I would agree. I think C-suite awareness of the risk profile and the risk appetite, to your point, I think every organisation will carry a certain level of risk appetite. Now, whether that does result in entirely you self-insure everything, or whether you do perceive there is a level of risk at which there is value in transferring that risk. In order for us to have a better cyber insurance marketplace, we are all going to continue to need to learn. I was speaking on a panel on this topic last year, and I think as an insurance industry, this is still a very nascent product line for us to write. And unfortunately, unlike many of the product lines we write, most lines we don't have actors against us who are constantly changing the threat dynamic. Now you can argue maybe in some climate change there is, but the vast majority of the time there isn't a changing threat dynamic in the same speed that we have with cyber risk. So we are still learning in this space, and we will continue to need to put limits out and raise awareness and learn from experience, which means, to your point around sharing and transparency, that's absolutely vital, because the insurance industry works on the basis of data, it works on the basis of trusted relationships, and with cyber, we are still in the infancy of having that.
Yeah, just quickly for me, I think the pool getting larger, I think will be a benefit to everyone. So small to medium-sized businesses, I think the threats and issues they face are fairly vanilla in some respects. Again, viruses, ransomware, that's probably criminal. It's probably about it. And again, I think the insurance sector, I would think, can get their arms around that pretty easily. So I think that would be better, and for the reasons that Jack touched on earlier, more education in that sector will be helpful.
Okay. Thanks a lot, very much. I don't have to summarize that. That was so clear. I definitely can't do better than that. Thank you so much to my distinguished panelists. Now I would like to open the floor for another 5 minutes of questions, please.
Joe?
Do you need that?
I'd like to go back to the first topic on risk quantification. Where I've seen it break down a lot is on the practical side at the security team level. So at a high level, I see risk quantification working well, but when the team is in the weeds and has limited resources, have you seen something like FAIR applied to, okay, I've got $50,000, should I secure my Linux endpoints that are 5% of the company, or go to multi-factor authentication for the last 7 SaaS apps? Like, that's the kind of tactical things that security teams are dealing with. And I don't see those team members using a risk quantification that's objective in those situations.
We solve those kind of problems all day, every day. Exactly this kind of rationalizing control investments like that, at a minor level to an aggregate strategy level for an entire security team. The key to this a lot is, and I don't know necessarily you'd find security operations teams utilizing FAIR, but I think the key is really finding that nexus between the tech stack and the business stack. So helping business leaders understand that, yes, this chain of technology solutions, from app servers, data, middleware, etc., this supports this line of business, this supports this business product, and here's the loss scenario that is attached to that. So that clarity between those two things I find very, very helpful for a lot of organizations to maybe fund both of those things, and that's really the key there for us. So I see that a lot, actually. I think it could be more, and I think a lot of security teams are very literate around control-based things, not necessarily risk-based thinking. It's a different discipline. I think that's important to make distinction before.
We had another question here.
And then we'll take it.
I'm Ron Beckstrom. I'd love to hear you talk a little bit about the game theory and the disincentives that occur in insurance, or the perverse incentives, in the sense of, for example, it is said that there's a higher than average rate of litigation in cyber insurance. And one of the reasons is because if you're a corporation and you're filing a claim with the insurance provider, if the insurance provider sues you, then in the public legal and court process, they can get a massive data dump on the lack of controls and problems inside the corporation, which often leads corporations to, it is said, not to go ahead and get insured, or not to rather litigate to get their own coverage. And I just would love a kind of candid discussion of pros and cons and issues. Is there any different behavior in the cybersecurity sector? And is game theory an applicable model for thinking about some of this?
Can I maybe just make one quick comment on cyber litigation, which I agree it probably does have, it has a reasonable high proportion of litigation at the moment, and I think it's because it's a nascent line of business. So if you think of traditional insurance contracts, it's very clear what coverage is. As an insurance industry, it is in nobody's interests to have the insurer and the insured not clear about what's covered. So unfortunately, sometimes that has to be sorted out through a court of law who determines what is the coverage. I think as an industry, we are trying to clear that up through the standalone cyber coverages to make it very clear, okay, if you have a cyber tower, you are covered for X, Y, Z within this tower. If you have something which sits outside of the cyber tower, those are where the coverage arguments are happening.
I think it's a good question. I think it's probably more a broader business culture issue, and I know jurisdictions different. It's more around class action for investors, for losses, and again, think of what's topical at the moment, Boeing, for example. You know, any insurance discussion on something like that, if it was cyber related, is sort of a bit of a side issue to something has gone wrong. The company, unfortunately, will have to live and die by the decisions they've made in the past around making themselves resilient, whether it's operationally resilient or cyber resilient, and I think everything else is a bit of a smoke screen, and unfortunately the lawyers and the firms will just have to live, and the existing shareholders will just have to live with the consequences of it, I think.
Excellent, thank you. I think we have one more question, quick question here. Yeah.
Pawan Dugal from India. Quick question. Why has the law been so slow in coming up with appropriate legal frameworks to assist the development of cyber risk as a discipline, globally and specifically in any jurisdiction?
Well, I could answer this in a way that would upset every lawyer in the room, I think. I think that the law profession typically is more of an after the event rather than upfront within the coverage design in the first place. And typically the model over many, many years through other types of business has been to argue in the court of law as to what the interpretation is, as opposed to having complete clarity up front. And to be fair to all the legal practitioners in the room, because you don't necessarily know what the argument will be when you originally write the contract. So it's not that people are not trying to do their job when they write the contracts. I think there are unforeseen circumstances, and particularly with cyber, as I said, I mean the threat, the unintended victims, so NotPetya obviously had many, many unintended victims of what was essentially state-on-state action. So that was never contemplated in an insurance coverage as to, okay, what if you're the unintended victim of a state action? Maybe we need to read more science fiction, maybe we need to think about more options as to what might happen when we write the coverage.
Thank you very much. With that, I have to close the panel. Thank you so much for this great